Let's examine breakout trading strategies in futures trading. This strategy involves entering a futures contract when the price breaks beyond a predefined resistance or support level. Traders anticipate that the breakout will result in a significant price movement. What is the strategic goal of breakout trading strategies in the context of futures trading? The strategic goal of breakout trading strategies in futures trading is to capitalize on significant price movements. These strategies aim to identify and trade breakouts from established price ranges, capturing profits from the ensuing significant price moves. The primary goal of breakout trading in futures is to capitalize on significant price movements following a breakout from predefined resistance or support levels. This strategy focuses on capturing quick gains from sudden and substantial market moves, aligning predominantly with speculation and capital appreciation objectives. How do breakout trading strategies perform under various market conditions? Breakout trading strategies are ideal for volatile and transitioning markets. These market conditions often lead to strong price movements, providing opportunities for breakout trades. However, in less volatile or stagnant markets, finding genuine breakouts can be challenging. Breakout trading is most effective in volatile markets where significant price movements are more common. It is particularly suited to markets transitioning from periods of consolidation to new trends, as breakouts often signal the beginning of a strong market move in a specific direction. What risk factors are involved in breakout trading strategies? A key risk factor in breakout trading strategies is understanding and managing the risks of false breakouts. False breakouts occur when the price appears to break out of a range, but then reverses direction, potentially leading to losses. One of the main risks associated with breakout trading is the occurrence of false breakouts, where the price breaks a level but then reverses direction. This can lead to potential losses if the position is not managed correctly. The risk of rapid price movements against the position also requires vigilant risk management, often utilizing stop-loss orders to minimize potential losses. What are the potential rewards of employing breakout trading strategies? The potential rewards of employing breakout trading strategies come from profiting from strong market breakouts. When a true breakout occurs, it can lead to substantial price movements, offering the potential for significant profits. The reward potential in breakout trading comes from capturing the gains of a strong market move following a breakout. The best-case scenario involves accurately identifying a genuine breakout and riding the subsequent price wave. However, traders should also be realistic about the average expected return, as not all breakouts will result in significant price movements. What considerations should be taken into account when implementing breakout trading strategies in futures trading? Key considerations when implementing breakout trading strategies include accurately executing the breakout strategy. This involves identifying reliable breakout points, setting appropriate entry and exit points, and using risk management tools like stop-loss orders to protect against false breakouts. To implement a breakout trading strategy effectively, traders should follow these steps. Identifying key resistance and support levels in futures contracts using technical analysis tools and historical price data. Monitoring these levels closely and waiting for a definitive price breakout. Entering the trade once the breakout is confirmed, either through increased volume or additional technical indicators. Setting an appropriate stop-loss order to manage risk, positioned just beyond the breakout point or based on a predetermined risk threshold. Determining exit points, either through preset profit targets or by monitoring price action for signs of reversal or loss of momentum. Considering factors like market news, economic events, and contract expiration dates that could influence market behavior and the success of the strategy. In breakout trading, quick decision-making and the ability to accurately interpret technical signals are crucial. Traders should be prepared for the fast-paced nature of this strategy and have a clear plan for both entry and exit to capitalize effectively on market breakouts. What about range trading strategies in futures trading? Here, traders identify stable high and low prices within which a futures contract is trading the range. They buy at the lower end of the range and sell at the higher end, capitalizing on the predictable oscillation of prices. What are the objectives of range trading strategies in futures markets? The objectives of range trading strategies in futures markets are to exploit price oscillations within a defined range. These strategies aim to capitalize on the predictable and recurring price movements that occur between established high and low price levels. The primary goal of range trading in futures is to profit from the oscillation of prices within a defined range. Traders identify stable high and low price points, forming a range, and aim to buy at the lower end and sell at the higher end. This strategy is typically aligned with income generation and capital appreciation through repeated short-term trades within the established range. How suitable are range trading strategies for different market conditions? Range trading strategies are most effective in stable, non-trending markets. In these market environments, prices tend to fluctuate within a consistent range, making it easier to predict and trade the upper and lower limits of the range. However, in strongly trending markets, range trading can be less effective. Range trading strategies thrive in markets that are stable and lacking a clear directional trend. In such conditions, prices tend to oscillate within a predictable range, making it possible to capitalize on these regular price movements. This strategy may not be effective in highly volatile or trending markets where price breakouts beyond the range are more common. What is the risk profile of range trading strategies? The risk profile of range trading strategies involves managing the risks of breakouts and sudden market shifts. The primary risk is that the market may break out of the range unexpectedly, leading to potential losses if the trader is not prepared to quickly adjust their strategy. The primary risk in range trading is the potential for a breakout, where prices move beyond the established range, resulting in possible losses. Traders must be vigilant for signs of market shifts or breakouts and be ready to exit positions to minimize losses. Understanding the dynamics of the specific futures market being traded is crucial in assessing and managing these risks. What rewards can be expected from range trading strategies? Rewards from range trading strategies come from gains achieved through short-term price movements within the range. Traders can profit by buying at the lower end of the range and selling at the higher end, or vice versa in short selling scenarios. The reward potential in range trading lies in capturing profits from short-term trades within the established range. While individual gains from each trade might be modest, repeated successful trades can accumulate significant returns. Traders should set realistic profit targets and understand that the average return will depend on market stability and the accuracy of the range identification. What are the key steps for implementing range trading strategies in futures trading? Key steps for implementing range trading strategies include identifying well-defined ranges and executing trades in a timely manner. This involves analyzing historical price data to establish the range boundaries and using technical indicators to identify optimal entry and exit points within the range. To implement a range trading strategy effectively, traders should follow these steps. Using technical analysis to identify clear high and low price points that form a trading range in the futures market. Monitoring the range for stability and ensuring it has been tested multiple times. Entering buy positions near the lower end of the range and sell positions near the upper end, ideally using limit orders. Setting stop-loss orders just outside the identified range to protect against potential losses from breakouts. Keeping an eye on market news and economic indicators that might influence the stability of the range. Considering the futures contract's liquidity as well as expiration dates, which could affect the range's reliability. Range trading in futures markets requires a disciplined approach to both entry and exit points, as well as a keen understanding of market patterns and technical analysis. Traders should be prepared for the meticulous nature of this strategy and be adept at recognizing stable trading ranges and reacting swiftly to any signs of market changes. Let's examine pullback trading strategies in futures trading. Traders identify a strong trend, then wait for a temporary reversal pullback in the price before it resumes the original trend. They enter the trade during the pullback, expecting the price to continue along the trend. What is the primary objective of pullback trading strategies in futures trading? The primary objective of pullback trading strategies in futures trading is to capitalize on price corrections within a trend. These strategies aim to identify temporary pullbacks or retracements in a prevailing trend and enter trades that profit from the resumption of that trend. The primary goal of pullback trading in futures is to capitalize on temporary price reversals or pullbacks within an established strong trend. Traders aim to enter trades during these pullbacks, anticipating that the price will resume its original trend direction. This strategy is mainly focused on capital appreciation by leveraging short-term price movements for potential gains. How do pullback trading strategies adapt to different market conditions? Pullback trading strategies are particularly effective in clearly trending markets. They are designed to leverage the predictability of price corrections in a market that is showing a strong directional trend, either upward or downward. Pullback trading strategies are most effective in markets exhibiting clear and strong trends. These conditions provide identifiable pullbacks within a prevailing trend, offering entry points for traders. This strategy is less effective in range-bound or choppy markets where distinguishing a pullback from a trend reversal can be challenging. What is the risk profile associated with pullback trading strategies? The risk profile of pullback trading strategies involves managing the risks of misjudging trend continuation. There is a risk that what is perceived as a pullback could actually be the start of a trend reversal, leading to potential losses if the trend does not resume as expected. The main risk in pullback trading is misjudging the nature of the pullback, mistaking what could be a trend reversal for a temporary pullback. If the trend does not resume as anticipated, it can lead to losses. Traders need to use risk management tools such as stop-loss orders to protect their positions from adverse moves. What potential rewards can be expected from pullback trading strategies? The potential rewards from pullback trading strategies come from profiting from short-term trend resumptions. By accurately identifying pullbacks and entering trades at these points, traders can benefit from the subsequent continuation of the trend. The reward potential in pullback trading lies in capturing gains from the resumption of a trend after a temporary pullback. The best case scenario involves correctly identifying a genuine pullback within a strong trend and capitalizing on the subsequent trend continuation. However, traders should be aware that not all pullbacks will lead to profitable trend resumptions, and average returns will depend on market conditions and the trader's timing and strategy execution. What are the key steps and considerations in implementing pullback trading strategies in futures trading? Key steps and considerations in implementing pullback trading strategies include identifying pullbacks accurately and executing trades in a timely manner. This involves using technical analysis to spot potential pullback opportunities within a clear trend and determining optimal entry and exit points. Implementing a pullback trading strategy effectively involves identifying futures contracts with a strong and clear trend using technical analysis tools like moving averages or trend lines. Monitoring for temporary pullbacks in the trend using indicators like Fibonacci retracements, candlestick patterns, or RSI for potential entry points. Determining the optimal entry point during the pullback and setting up exit strategies, including profit targets and stop-loss orders. Being vigilant about market news and economic reports that could influence the trend's strength and the pullback's validity. Considering the contract's liquidity and expiration date, as these factors can impact price movements and trend sustainability. Pullback trading in futures requires a solid understanding of market trends, the ability to distinguish between a true pullback and a trend reversal, and the skill to execute trades swiftly and effectively. Traders should be prepared for the dynamic nature of this strategy and have the necessary risk management measures in place.